The jobs data in America is decent. The inflation numbers out of Germany slightly worrying. We'll get into that in just a moment. Futures this morning, negative about 1/3%. Good morning to you all. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York City, we begin with the big issue. Hopes for a diplomatic breakthrough fading fast. Russia's promises meeting skeptical minds.
I don't read anything into it until I see what their actions are. We'll see if they follow through on what they're suggesting.
And the Pentagon echoing the president's sentiment.
We believe that this is a repositioning, not a real withdrawal, and that we all should be prepared to watch for a major offensive against other areas of Ukraine. It does not mean that the threat to Kyiv is over.
And now even Russia questioning progress, with the Kremlin spokesperson saying the following: "We can't report anything very promising, no breakthroughs. Very, very prolonged work is still ahead." Our team coverage starts right now with Bloomberg's Kelly Lyons in New York and Emily Wilkins down in D.C. And Emily, to start with you, is there anything to be hopeful about here?
I mean, we can be hopeful that there might be more aid coming for Ukrainians. We know that the White House is considering providing another $500 million for that. That request will probably need to go through Congress, but there's still a lot of strong bipartisan support. Look, if you look at where the U.S. is today, if you look at where Washington is today, there's no signs that anyone is changing their stance, hoping for a soon-to-be-announced a peace or withdrawal or anything like that. Lawmakers are being briefed today, both in the House and Senate, from officials with the State Department, Defense Department, Joint Chiefs of Staff. There's still hearings on this. Lawmakers are still very much prepared to continue to work with this issue and see what ways they can continue to provide aid to Ukraine. And if they need additional sanctions on Russia, remember that one to end regular trade relations is currently stuck in the Senate due to Senator Rand Paul having a hold on it. But they are hoping to come to an agreement on that within the next week.
Kayleigh, there was hope for a breakthrough. It looked like we had one. The equity market rallied this morning. We're down about 1/3%.
Yeah, the market certainly took that hope in stride yesterday. A big rally for stocks. What really was just one in a series of up days. The S&P 500 up 11% in just the last 2 weeks, but futures are in negative territory this morning. Not a huge loss. We're down about 0.4% or so on S&P E-minis, but you're also seeing a sentiment reversal in the commodities markets. Crude, after 2 days of pretty heavy losses, up 3.5% on WTI. We're back around $108 a barrel. And of course, not a lot of movement in the Treasury market. But what's different today that wasn't true yesterday is that the curve is steepening, not flattening. Of course, this is another thing the market has to worry about. For a very, very brief moment yesterday, the 2-year Treasury yield was above that of the 10-year. A very brief inversion, the first time since 2019, which can signal potentially a recession coming down the line. Of course, there is debate about that, whether this time is different given the Fed's heavy hand in the bond market. But looking at history, inverted curves always don't necessarily mean a bad thing for equities. Invesco notes going back to 1965, the median length of time between an inversion and a recession has been 18 months, matching the median stretch between the onset of an inversion and an S&P 500 peak. On average, the index gaining about 19% over that time. But a lot, of course, could depend on how aggressive the Federal Reserve is. If there's no breakthrough in Ukraine, does it exacerbate inflation, make aggression more likely, or does it make the central bank more cautious? I think that is an open question, John.
Kelly Lyons, thank you. Kelly, alongside Emily Wilkins down in D.C. Thank you to you both. Joining us now is Morgan Stanley's Lisa Shalett, Mike Schumacher of Wells Fargo. Lisa, first to you. Is there a reason to be hopeful here in this market?
I think we're skeptical of getting ahead of ourselves here with regard to hope. While we respect the amount of liquidity that's out there and the desire to, quote unquote, buy the dip after we saw a correction in the S&P 500 and a bear market in the NASDAQ, the reality is that, risk has really fundamentally gone up, whether you're talking about the geopolitical risks, as many of your guests have talked about this morning, or you actually focus on fundamentals. We continue to caution folks about the vulnerability of earnings here. And what folks have to remember is that the S&P 500 earnings are not the U.S. economy. And S&P 500 earnings are going to be very vulnerable to this mix shift between goods and services that we expect, because the index tends to be, dominated by manufacturers of stuff. And it's also an index that tends to be levered pretty largely to generating sales and profits in Europe. And to the extent that the German, IFO and the ZOO, numbers mean anything, the potential for a downturn in Europe or a severe slowing there seems quite high right now.
What a problem we've got in Europe. Mike Schumacher, to pick up on what Lisa said, the IFO, German business confidence last week, collapsing. Their word, not mine. This morning, CPI. This is the line from the team here at Bloomberg. Inflation jumping to the highest level since records began after reunification in the early 1990s. We have a 7 handle on inflation in Germany, Mike Schumacher. So we've got downside risk to growth, upside risk to inflation. And Mike Schumacher, an ECB stuck between a rock and a hard place. What do they do?
ECB is in a really tough position, Jonathan. Now, if the situation in Ukraine calms somewhat, then I suppose you can imagine ECB hiking 25 and maybe 50 at some point this year. But if the Ukraine situation remains tense, the ECB is really just about out of options. I would say a rate hike in that case is probably off the table. It continues bond buying, but it really has no good place to go.
Do you think they have to tolerate these inflation prints, Mike? Is that what you're saying?
I think they're scared, but I think perhaps while the conflict rages, they may have to tolerate inflation. They can talk tough, but as far as actually doing a rate hike, which the ECB has not done since 2011, and by the way, it's got a checkered history in terms of rate hikes, I think the ECB's current strategy is to hope.
Mike, how do you think the German bond market trades that? I've got 2s through 0, up 9 basis points on the day. I've got 10s at 68 basis points, up 5 or 6 basis points. If an ECB sits this out and watches inflation surge and growth potentially go into negative territory, how do bunds trade that story?
Yeah, bunds get drilled in that case, Jonathan. I think you get a much steeper curve in the bond market, and there have been a lot of interesting aspects to, let's say, the bunds relationship to treasuries this year. First and foremost, the 10-year bond has been tracking the 10-year treasury yield almost basis point for basis point. Not quite, but pretty close. Typically, the bond moves maybe half as much as the treasury. So we think that's going to diminish, and the bonds will move less. But if the ECB sits it out, I think you see longer-term German yields go up as that inflation premium gets priced in. Short yields stay where they are, deeply negative in some cases for some countries, as the ECB really sends a signal we're not doing much. So steeper curve, higher yields, but not to the degree we've seen so far this year.
Lisa, you touched on the European risk. We used to talk about the prospect of the US decoupling coming out of the Eurozone debt crisis. Do you doubt the US's ability, and not just the economy, but the equity market, to decouple from some turbulence potentially in Europe through the rest of this year?
Well, look, I mean, I think the decoupling of, U.S. equity markets has been a theme that we've quite frankly seen almost since the great financial crisis back in 2009. It's been a pretty long run of, 12, 13 years where, U.S. market outperformance has been, pretty stunning. I think our view is that, as the forces that we're seeing, whether it's from the global pandemic, whether it's global central bank tightening, whether it's global inflation, global shifting in geopolitics, I think it's going to be very hard for the U.S. to sustain that level of outperformance and that gap. So to answer your question, I think we do recouple here. And for the U.S. markets, I think that means a downward rating from what, has been pretty large multiple expansion over the years.
Lisa, is that an index call, or do you have some sector preferences below the index that you've got a little bit more conviction about?
Yes, certainly. So we do. And Jonathan, thanks for pointing that out. Our skepticism in the U.S. market is very much at the index level. We recognize that the recent sell-off has created a lot of stock picking opportunities. And so we're trying to do that actively. And we're finding a lot of things to buy in industrials, in materials, mining, in the energy sector, obviously, healthcare, consumer services. Those would all be be places that we're pretty aggressively stock picking. And quite frankly, while some of my colleagues downgraded financials earlier this week, Mike Wilson and Betsy Graysick at Morgan Stanley, for investors that have maybe a 24-month horizon, we still think that there's interesting things to buy in financials as well.
Elisa, I noticed the move from Betsy and from Mike as well. And there were 2 points that Betsy made. There were a load, but I'll boil it down to 2. Ultimately, we've already priced in the rate hiking cycle. And 2, this cycle is going to be really sharp and quick, Lisa. Does that make a difference to how the financials trade? If we get a really short, sharp rate hiking cycle of 50 basis points, 50 basis points, 50 basis points, and again.
Well, certainly I'm not one to ever, question Betsy's expertise here. And so, I think one of the points that she's making is whenever, the curve moves this far, this fast, and it becomes headline grabbing, that, your deposit betas go up, or essentially, in layman's terms, the amount of interest that, banks need to pay, depositors and savers. And that wasn't the case, back in 2016, 2017. And so that can, in the short term, can squeeze bank margins and bank profitability. But if we get through this pretty quickly, it's our assertion that banks are going to be able to navigate what is ultimately going to be a re-steepening curve on the other end of this by 2023.
Mike Schumacher, you made your call on the European curve, the bund curve specifically. Can you give it me on the Treasury curve as well? 2s10s right now, 5 basis points. A very brief dip below 0 in yesterday's session.
Yeah, Jonathan, 2s10s was inverted for a nanosecond or 2 yesterday, but we think the curve gets substantially inverted very quickly. And if you look at what the bond market's telling us in forwards, something like -30, -35 at the end of the year, those are staggering numbers. I'm on board with that. I think that's pretty likely. As far as the big driver is going to be just how quickly does the Fed hike. Currently, the market's priced for more than 200 basis points of incremental tightening this year, which is mind-boggling, frankly. So if the Fed delivers that, then yes, deeply inverted. We think inverted is probably the case. I will tell you, though, Jonathan, we think the telling point for the bond market is going to be really not how much is priced for 22, but how much does the market ultimately price for 23? Currently, there's a lot loaded into this year, not much for next year. We think that's wrong, frankly, and people will have to equilibrate.
Interesting. Mike Schumacher, Lisa Shalett sticking with us. Deutsche Bank came out with a note this morning on yield curve inversion. They looked over 6 cases of inversion and said the following. It took another 3 to over 25 months before hitting the peak. They're talking about the equity market. On average, the S&P 500 returned 19% from the day of the curve inflection to its next peak. Just something to think about. We'll talk about it a little bit more around the opening bell with David Kostin of Goldman Sachs. Let's get you some moves ahead of the open about 20 minutes away. Here's Abby.
John, well, stock futures are down modestly. That S&P 500 E-mini futures down about 0.4%. Let's take a look at 2 laggards and 2 leaders to the downside. Apple perhaps breaking an 11-day winning streak. Will it make it for 12? We don't know right now. Not down 0.6%. And of course, that winning streak was the best since 2003. Chewy plunging down 15%. Weak fourth quarter results. Their view was lackluster, perhaps reflecting coming out of the pandemic. Plus, there's a 29% bear short interest. To the upside, though, oil, of course, rallying today, up above $108 per barrel for WTI crude. So some of the energy names are rallying in sympathy, including Chevron up 1%, and then Lululemon up 6.8%. A mixed quarter, but sales guidance very strong, beating the street. Plus, the board approved a $1 billion buyback. That never hurts, John.
Abby, it never hurts. Thank you. Thank you very much. Coming up, Western allies tempering optimism over potential progress in Ukraine.
I had a meeting with the heads of state of our 4 allies in NATO, France, Germany, the United States, and Great Britain. And there seems to be a consensus that let's just see what they have to offer.
Fed officials trying to block out the noise with their sights set on tighter policy. That's next.
We're going to continue to keep strong the sanctions. We're going to continue to provide the Ukrainian military with their capacity to defend themselves. and we're going to continue to keep a close eye on what's going on.
Mistrust and verify. Western allies remaining skeptical following Russia's pledge to scale back military operations in Ukraine. Fed officials trying to block out the noise.
I am very open to going faster. I'm not willing to commit to that today, but I think 50 basis points is quite possible. We'll just have to let this play out and be very attuned to the data.
On the data and this Fed, it's Mike McKee. Morning, Mike.
Good morning, John. Well, a lot of people are talking about the curve inversion and the idea that suggests the Fed's going to go too far, over-tighten, the economy slows, we go into recession. The question is, with monetary policy working with long and variable lags, how's the Fed going to know? Bill Dudley told us yesterday he thought the SOM rule comes into effect, the idea that if you start going up on unemployment, you end up in recession, which is true according to the SOM rule. But look at the red recession bars there. The SOM rule peaks, the unemployment rate peaks deep into the recession. So it's not a forward-looking indicator. What do we do from here then? How does the market look at this? Well, you're going to watch jobless claims. Remember those? We used to care back during the pandemic. Jobless claims will give us an idea of whether the labor market is loosening up or not. Jobs plentiful and hard to get in the Conference Board survey, and the ISM employment indexes. Those will be kind of the leading indexes. The payrolls report, we get payrolls report on Friday, lagging index. That jobs plentiful indicator is kind of interesting. Take a look at this. The white line there, jobs plentiful. The blue is jobs hard to get. And you can see jobs plentiful at a high for the entire series. That's a record. Jobs hard to get, very close to a record. Just 1 month in the previous 40 years was lower than that. But look at the recession numbers. When we get to these peaks of jobs plentiful, that tends to tell us we're getting close to recession. So that's something to keep an eye on as we talk to Fed officials and find out whether they think they need to go as far as, let's say, Mike Schumacher was talking about earlier.
You're speaking to another one a little bit later, Mike. Richmond Fed President Tom Barkin. I'm looking forward to it. What's the big one for him?
Well, we want to know where he stands on the 50 basis point question, but then can they bring us in for a soft landing? Obviously, he's not going to say, no, we're going to do a recession. But what are the odds that they can pull this off? And do they think they need to go above neutral in order to slow the economy down enough?
Mike McKee, must-watch TV whenever he's with a Fed official. I'm looking forward to it, Mike, at about 10:30 Eastern time, so an hour and 10 minutes from now. Mike, thank you. Just a quick one, a headline coming from Dow Jones. The EU is considering new Russian bank sanctions, according to diplomats. That coming from Dow Jones just moments ago. For the broader market, you know the story by now. We've had a massive move on a 2-year yield in America through the whole Treasury curve. It seems to me the consensus is now a 50 basis point move at the next Fed meeting, a 50 basis point move after that. And even with that conversation, big tech has rallied and rallied hard. We'd have 11 straight days of gains on Apple to close out yesterday's session, the longest winning streak since 2003. So Lisa Shalett, what is going on and why is big tech rallying in the face of this?
So I think, our hypothesis is twofold. One is that there continues to be an extraordinary amount of liquidity and desire among investors to, quote unquote, buy the dip and own the winners that have dominated literally for the last, 12, 13 years. I think a second dimension of this is this idea that owning those names is defensive. In this backdrop of potentially an inverted yield curve, with this potential of slowing economic growth. Our thesis is, as Jonathan, somewhat opposed to that view. Our sense is that some of these names are fully valued, are already at peak profitability, and are not going to be immune to the forces that we're talking about. We are not talking about, small micro economic things here. We're talking about things like geopolitical risk, Fed policy execution risk, inflation risk, and no matter how great some of these companies are, we believe that they're going to feel the implications of it.
Consumer confidence is already rock bottom. Mike Schumacher, it's fascinating for me to see you, Mitch. When it comes out, you look through the data, decade lows, you go through the survey, you see some of the commentary, and you look at the output numbers off the back of it, and it's hard to find a relationship, Mike, between rock bottom consumer sentiment and just the output numbers we seem to be churning churning out in the U.S. economy. What do you make of that, Mike? Is that a disconnect? Does one start to lead the other? What's happening there?
I think the sentiment measures, John, you've got to think about what drives those. So, for instance, no pun intended, people certainly care a lot about the price of gasoline. It's been up, it's been very volatile, it's probably weighing on sentiment. It's tough to get really fired up about the state of the world when you've got a shooting war going on in Europe, so it's factor number 2. So a lot of things weigh on sentiment that don't necessarily influence people so much when they go to the job and work on producing more widgets or more cars or whatever it might be. So I think there is a bit of a disconnect, as you said, and it really is going to be driven by inflation and by war prospects going forward.
Mike, to what extent should I ignore that data then when it comes in?
I ignore it pretty comfortably, sleep well at night, so I don't give it a lot of heat, Jonathan, but I think Michael McKee really hit the nail on the head. When you think about the prospects for the economy, focus on the jobs market, focus on the actual data, focus on jobs openings, job quit rates, that sort of thing. That's going to give the closest thing we have to a real-time indicator as far as how the Fed's policies are playing out.
Mike Schumacher, Lisa Shalett, great panel going over some of the big issues right now to you both. Thank you. The ADP report behind us, 455 was the number, 455,000. The estimate was 450K. Payrolls Friday just around the corner. The numbers you need to know, 490K is the median estimate. The previous read was 678,000. Of course, that's a moving target. That's from our survey. It will keep on moving through to Friday morning. And looking at unemployment, the expectation at the moment, the median estimate 3.7%, just a little bit lower than the 3.8 that we saw in the previous month. Those numbers, of course, for the month of March, as we wrap out the month of March in about a day or so. Coming up, the morning calls, and later, how big tech has been overcoming rising interest rates. That conversation just around the corner with this guy, David Kostin of Goldman. Looking forward to this one around the opening bell. From New York City, this is Bloomberg. 5 minutes away from the opening bell this Wednesday morning. Good morning. We are negative about 1/3% on the S&P. On the Nasdaq, down about 0.6. That's the price action. Here are the morning calls. First up, Goldman downgrading Bank of New York Mellon to neutral, 60 price target, expecting 2 consecutive years of declining net interest income. That stock is down 1%. JP Morgan downgrading Procter & Gamble to neutral, recommending investors lower their expectations amid lingering cost and currency headwinds. And finally, Amazon getting its first sell rating since 2020, with BNP initiating coverage. The analyst seeing nearly 20% downside due to continuous bouts of inflation shock. We're down 0.6 there. Up next, from inflation to rising interest rates, big tech finding ways to overcome the obstacles. David Kostin of Goldman is coming up next at the opening bell. This is Bloomberg. "24 seconds away from the opening bell in New York this morning. Good morning. Your Wednesday morning price action shapes up as follows. Down about 1/4% on the S&P after a 4-day winning streak. On the Nasdaq right now, down 0.5%. Even with the bond market doing what it's been doing, this equity market month to date is doing pretty well. Switch up the board and get to Treasuries. Yields shaping up as follows on a 10-year. Going into payrolls on Friday. Yields inching a little bit higher again. 240-220 on 10s, up 3 basis points. The euro finding some strength in the face of the highest inflation print we've seen since the 90s from Germany. Euro dollar 111.42. Let's call it 111.43. Up 0.5%. And crude rallying now, up by more than 3% to 107.82. Yesterday, some hopes for a diplomatic breakthrough, in this morning, seemingly everyone throwing cold water on that. In the session right now, about 30 seconds in, we decline 0.25%. Turned yesterday upside down for energy, yesterday morning anyway. Crude is higher, energy's higher, and the equity market up 0.6%. Consumer discretionary is down about 0.5%. For your moves at the opening bell, here's Abby.
John, let's start and stick with that energy story. And we are talking about most of the energy names higher at this point, as you were just mentioning, energy the best sector. In particular, BP right now up more than 1% in sympathy with oil. WTI crude back above $108 per barrel. Rio Tinto also higher, so you see a little bit of a rebound for materials. Micron, they put up a really nice they put up a beat and strong outlook, giving the stock a nice boost, up about 5%. Chewy, on the other hand, down 15% 16%. This, of course, after they put up a mixed quarter. The view for sales not great, and there is a 30% bearish short interest. Those bears very happy today, John, with Chewy down 16%.
Abby, thank you. A key feature of the rally through the month so far has been the massive moves we've seen out of big tech. Ed Ludlow on the West Coast, driving you through some of the price action. Morning, Ed.
Yeah, morning. I was going to start with oil, John, up 4% on WTI West Texas Intermediate crude, up to about $108 per barrel. It's interesting. There's signs that production in Russia has been wavering, even though we had such optimism on Tuesday around talks with Ukraine and that would boost supply. Also, the Bloomberg Commodity Index down by around 2 percentage points, snapping basically 2 straight days of 2% gains. There's a change in that equation, right? And you look at how that's playing out in the equity markets and investors trying to position themselves, energy, materials. Where do you put yourself in this market when you're not sure on the long-term outlook for the supply? The materials stocks up around 0.2%, energy stocks down 1.3%. But yes, back to big tech, because you know that's where I focus. We've had this broad rally, right? And the mega caps, the tech stocks have been the mainstay of that. The NASDAQ, even though we're a little softer on Wednesday, seems a little bit unstoppable. But there are warning signs that the gains of the past 2 weeks has hallmarks, essentially, of this bear market rally, despite that sustained momentum. Mega caps, you look at the value we've added across the biggest technology stocks, $1.5 trillion over the last 10 days or so. What derails that? What is it that the market's actually tracking? What is the psychology here? You and I have discussed over the first 3 days of this week how not all tech stocks are created equally, right? We're worried about the outlook for higher rates than the Fed, but there is this move, it seems, into higher quality growth stocks. But what I would say, looking across the NYSE FANG Plus Index this Wednesday morning, Apple, John, up for a 12th straight day, just up 0.2%, on course, of course, for that all-time record winning streak, but the rest of mega caps a little softer this Wednesday morning.
What a run it's been. Ed, thank you. We'll catch up with you a little bit later. Ed Ludlow there on the West Coast. The Nasdaq 100 entering today at a 12-week high. Goldman say this: leverage investors have participated by aggressively reducing their equity exposure. They go on to say short covering by these participants helps to explain why some of the longest duration equities have recently risen sharply in the face of rising interest rates and a more hawkish Fed. I'm pleased to say the man behind the note joins us now, David Kostin of Goldman. David, always good to catch up, buddy. Let's start right there. Yields are flying. They've been surging through March. We've got hawks all over the place and big tech has rallied. Walk me through piece by piece why this has been happening from your perspective.
Well, there's a concern about a upcoming recession. It's not the Goldman Sachs economic forecast, but certainly in the minds of many portfolio managers, that is a increasing risk. And that is one of the reasons why their attractiveness of some of the largest technology stocks and some of the more durable earnings companies in many different sectors. But we'll focus on tech for just a minute. And I believe that is a key kind of underpinning thesis for why the stocks have done well. We are about to embark on the first quarter earnings season that will kick off around April 11th or so. And I believe that there's going to be a significant number of negative earnings surprises. In fact, you probably get a large number of pre-announcements in the coming weeks just before the earnings season. The reason I believe that is that it's been a particularly difficult quarter from a operational point of view for management. So you think about the first month of the year in January was largely overshadowed by Omicron, and then you had the higher rates that really kicked in February, and then you have most recently the tragedy in the war in Ukraine. So you have these events that have really impeded a lot of sales for a lot of companies, and I think managements have been reluctant to give guidance, understandably, because things are really swiftly moving. And so I think that's a question on the prospect for earnings. Jonathan, the earnings revisions have been negative for most sectors in the market in the last month. And frankly, they've been pretty tepid for the full year in the first 3 months. But the most recent kind of activity has been downward earnings revisions. And I think that is a concern about on the part of many portfolio managers and which companies have the probability of actually delivering on expectations. And therefore, a lot of the technology companies are perceived as having more stable prospects of earnings.
Do you share that view, though, just on tech? I mean, you've got this view that we're going to get some earnings warnings here, David. Where do you think those warnings will be concentrated?
Well, I think you want to, then I feel very strongly, you want to break the technology sector into a couple of pieces. One is profitable, growing companies, and some there's a large number of unprofitable companies that are still growing their revenues and forecast to grow revenues quite sharply. Jonathan, those two groups of stocks basically trade at the same valuation level, around 7 times enterprise value to sales. That is sort of inconsistent in terms of a normal valuation, well-ordered market. Normally, if you have a corporations and a bunch of companies that are growing at 20% top line with very high margins, say north or above 20%, and then have a group of stocks where they're also growing rapidly, but they're very thin margins, perhaps losing money, those should not generally trade at the same level of valuation. And therefore, I think there's more risk in some areas in technology. Where you're likely to get some of the weaknesses, probably in some of the consumer discretionary oriented and facing companies, some of the consumer staples areas where the consumer has been is challenged in this environment. So we think about where that's weak expectations on profit growth. That's an area that we would be concerned about. Obviously, another area is some of the companies that have a lot of revenue exposure towards Europe, as compared with companies that are primarily domestically facing. That's another kind of split in the market in terms of investor focus, which I happen to be focused on a lot with conversations. Dividends would be another area of focus. Those companies that have both increased their dividends already since the start of the year and are forecast to have kind of increased dividends hikes this year generally offer some ballast and some insulation to some of the broader macro issues of a decelerating economy. I think the general environment is you have weakening profit growth and you have a higher interest rate environment, and in my calculations, with a 10-year U.S. Treasury yield, nominal yields at around 2.7% at the end of this year, and the economic forecast that we're assuming, which is deceleration the rest of this year, that supports around 4,700 level for the S&P 500, which is very limited upside. Yeah. Whereas in contrast, if you had a recession, you'd be closer to, say, 3,600, much lower. I think the distribution of risks right now is more to the downside than the upside, given that combinations I just mentioned.
Interesting. Well, I'll come back to the rates call in just a moment. You mentioned the consumer. I think that issue is multifaceted because going through your research as well, you also talk about the household allocation to equities today relative to recent history. And David, I wonder if the consumer makes you worried about consumer spending, does it also make you worried about household allocation to equities, which has been supportive of this rally year to date?
Well, it's a situation from an asset allocation point of view that it's not just for the consumers. If we kind of expand that for a moment to think in addition to mutual funds and pension funds and foreign investors, collectively, those categories, they control or they own or they represent about 90% of the ownership of the U.S. stock market. Obviously, the major portion of that, about 38%, is comprised of consumers. Those entities have around 50% of their asset allocation to equities, about 20% to bonds, and around 12% to cash, balance being gold and commodities, things like that. But those three major categories, where else is one going to be allocating money in this environment? With the bond yield forecast that we have at Goldman Sachs, rising rates means it's a real headwind for getting a positive return in the fixed income market. Cash likely to continue to get a better return as the Fed continues to hike rates. But in the equity market, broadly speaking, there's a bias in favor of that from a risk premium point of view. So at the end of the day, we think about the opportunity set in equities, modest upside, admittedly, I think relatively, also some downside. Obviously, there's a distribution of some risks. Sure. But the balance sheets of a lot of companies are very, very strong, and they're buying back a lot of stock, which is the other supportive attribute of equities at this point.
David, not every research department is fully aligned between rates, the economists, and the equity strategists, but I want to pick on your rate strategist just for a moment. They've got curve inversion year-end this year, year-end next year, and year-end the year after. David, that's a very strange dynamic to have that consistently through the next 2-3 years. I want to understand what that means to you from your perspective, even if you don't agree with it. And you can say if you do or you don't. But even if you don't, I want to understand if that's going to be the case in rates, what does that mean for stocks?
Well, it means that the trajectory of increase in the level of the market or decrease in the market is going to be a a function of profit growth. It's incumbent upon companies to deliver better earnings, probably through margins. And the reason for that, Jonathan, is the idea of a decelerating economy means that the challenge for companies is to generate revenue growth as the economy is slowing. So therefore, there's much more focus on the margin structure. And what you are seeing now and what you are likely to continue to see this year is corporate spinoffs. That's likely to be the major corporate finance development, in my opinion, as you see the balance of 2022 continue, because corporations are thinking about ways to improve their margins and create value for shareholders in an environment when the economy is decelerating, getting higher sales is more difficult. Now, coming back to your question about rates, the idea of valuation, headwinds, that's basically what a higher rate environment is going to entail. You've got higher short rates, you've got higher long rates, you have a yield curve that is basically, bear flattener in terms of the trajectory and reshaping of the curve. That's a more challenging environment for equities. The companies that are buying back a lot of stock, likely to be an area that outperforms in that case. Companies that are paying dividends, also a way of thinking about that. The overall index, Jonathan, is likely to be a more shallower trajectory of, upward, generally speaking, upward move in the equity market, because the economy generally is still rising. We are not anticipating a recession, although the a inverted yield curve would suggest that is certainly a risk. That's one of the reasons, many reasons why, but that's a particularly intermediate risk why investors are so focused in this area.
Can I finish on this question, because I know you've got to run, David? Are you losing conviction on your year-end price target? Just going through this conversation with you right now, how high is your conviction on that call right now at 4,700?
Well, there are a couple of ways to think about it. Number one, we have had the best two-year return in 75 years. The U.S. equity market has doubled in value from the low of the pandemic. That's a better two-year return than you had coming out of the financial crisis, and it's a better two-year return than you had coming out of the 1974 bear market. So it's been a particularly, powerful rally. And the idea of margins at record high levels with all of these headwinds on supply chain disruptions, commodity prices, labor costs, these challenges have made it harder for a lot of managements to navigate in this environment. But we're not anticipating a recession. So therefore, the history shows, Jonathan, when you are a buyer of the equity market, when it goes down by 10%, and recall we've been down 13% from the high on January 3rd, down 13%, the market typically rallies back to just about the peak of where it was in the next 12 months. So therefore, if 4,800 was basically the high on January 3rd, our forecast of 4,700, a little bit below that, at the end of this year is consistent with what has happened historically. That's not how we arrive at the forecast, but you ask about the conviction.
Of course.
That's generally the trajectory that I would anticipate the market, kind of haltingly getting towards later this year. Remember, you'll have a lot of hikes in the near term, but we'll have a midterm elections in November. And when you look at the end of the year, that will then be behind us. And so looking forward, I think that's the idea, and that's the building blocks behind our forecast.
We've got to talk in earnings season as well. David, good to catch up, buddy. It's been too long. Thanks for your time today. David Kostin at Goldman Sachs. Nice to see you too. Coming up, Ukraine's capital still under threat despite Russia's promises to scale back military operations.
Russia has failed in its objective of capturing Kyiv, but they can still inflict massive brutality on the country, including on Kyiv.
And sanctions continuing to pressure Russia's debt payments. That conversation just around the corner.
Nobody should be fooling ourselves by the Kremlin's now recent claim that it will suddenly just reduce military attacks near Kyiv, or any reports that it's going to withdraw all its forces.
It's a delicate time for Russian debt. Expiring grace periods on Russian debt threatening to spark default. Some of the country's biggest companies racing the clock as certain banks continue holding up payments. Damien Sasser of Bloomberg Intelligence joins us now. So, Damien, let's go through this piece by piece. You've got Russian corporates, one, and then you've got the Russian government, two. Can you help me understand how recent sanctions have affected the flow of payments through corporates into the end investor and through the sovereign to the end investor as well?
Sure. So, I mean, look, we've had a number of Russian corporates that have successfully made payments to their creditors on their foreign debt. And same with the Russian sovereign. So far, so good. They've made their coupon payments. They made $117 million at mid-month. They just made another $102 million. And then they've actually started wiring the funds on a $2 billion principal payment, which is due on the 31st. They've given creditors the option to accept payment in ruble, but obviously no one's taking up that option, at least no real investor here in the U.S. So shifting to the corporate side, what's interesting today is we have not one, not two, but three, well, really 2.5 companies that have grace periods expiring on coupon payments that were due. What's interesting about all three of these companies, those being Russian Rail, Eurochem, and Shalett, is that, well, 2 out of the 3, Citigroup is the payment agent. And Citigroup has really towed the line here. They want to make sure that they are not violating OFAC sanctions, that they are doing everything by the book. And what this is doing, in the case of Severstal, is there's a technical block-up. And so they aren't able to make payment. These companies are unable to make payment because they don't have all the paperwork in place, Jonathan. And so that's what these companies are contending with. And so it's not about capacity or willingness to pay. It's about the technical ability to make that payment, which matters most.
It's truly original, isn't it, to be thinking about it that way. We're looking at dollar ruble at 84. Damien, when you look at that, what kind of a market am I looking at? Can I even call that a market?
Yeah, no, I don't really believe you can. I've been looking at it as well. And look, I mean, it certainly reflects probably some movement of money, between Russia and some of its counterparties. But certainly it is in no size and a very illiquid market. And if you just look at the way forwards and other products off the back of FX trade, I mean, very illiquid, very volatile. You really can't rely on the pricing. But to your point, 83, I mean, where were we trading just a week ago? I think at 110, 115. I mean, it's come a long way. I just don't look at it anymore, though, Jonathan. To be completely frank, it doesn't really reflect the clearing price for the group.
You're not alone. I'm in the same position. I'm looking at it now. 2 Mondays ago, a 110 handle. This past Monday, 101. Right now, 84. And I'm not sure who's trading it either, Damien. Can foreigners sell their stocks yet? Over in Russia? Are they still banned?
It's all banned. I mean, they can't, they banned short selling. They banned the ability for foreign investors to repatriate any be it equity or fixed income. If it's local currency debt that you own in Russia, you can't get your money out. So the ruble is so not reflective of what the reality of trying to move money into and out of Russia is. But what's interesting, and I've talked about this before, if you look at the state of the Russian financial system, you look at their amount of repo outstanding, that to me is kind of rolling off, which means that at least on the ground, things are getting a little bit smoother. Liquidity is a little bit improving for locals and households on the ground in Russia.
Damien, good to catch up, as always. We'll do it again before the weekend, I'm sure. Damien Sassow there of Bloomberg Intelligence. We are about 22 minutes into this session. Equities down 0.2 on the S&P, on the Nasdaq down around about a third. With some of your movers, here's Abby.
Well, John, related to the de-escalation hopes fading, not surprisingly, we have oil popping, but we also have stocks with particular Russia and Ukraine exposure falling. Let's take a look at some of them. Point in case AerCap, the world's largest aircraft leasing company, it is down 4.5% at the lows, down closer to 12% on the news that they have filed a $3.5 billion insurance claim on Russian planes stuck in Russia. Estee Lauder has nearly 3% of revenue from Russia and Ukraine also falling. Renault down 3.25%, considering an ownership transfer of its majority-held Russian venture Avdovaz, and then Wizz Air Holdings down nearly 3%, of course, the airline most exposed to the region. Interestingly, though, John, on those de-escalation hopes yesterday, it took the VIX, that volatility or fear index here in the U.S., below 20, still there at 19, but the European VIX still elevated closer to 27. So the fears are lingering there. And not surprisingly, over the last 2 months, the S&P 500 outperforming, in fact, rebounding up 4.3%, but the stock 600 down, the EM markets down, and Russia, that index down 28%. So lots of pain still being felt there, John.
Abby, thank you. We have an inflation shock in Europe. The German 2-year up 11 basis points, positive 4 basis points. We haven't been in positive territory since 2014. That happened in the last 24 hours. Guy Johnson's going to run you through some of the data, I'm sure, a little bit later this morning. Up next, your trading diary from New York. This is Bloomberg. 25 minutes into the session, we're down about 0.25% on the S&P, on the Nasdaq down 0.5%. 4-day winning streak coming into Wednesday. We snapped that just a little bit. That's the stock story. The bond market story gets a little bit more interesting. The Treasury's at 236, but in Europe much more so, through zero on a German 2-year, with inflation in Germany with a 7 handle. That's the price action. Here's the trading diary. Richmond Fed President Tom Bargin speaking with Mike McKee. Don't miss that. It's in 34 minutes time. Then President Biden providing an update on COVID and its strategy at 1:30 p.m. The White House's strategy. They'll unveil that a little bit later. Jobless claims coming up Thursday morning. Then on to Friday. It's payrolls Friday. Your median estimate 490K. From New York, this was the countdown to the open. This is Bloomberg.